Hey everyone, and welcome back to the channel. In today's video, I want to talk about why I haven't bought any stocks since September of last year, which is quite a long time for an investor. I'm sure many of you out there have bought stocks in that time. So in this video, I want to talk about why I haven't bought stocks and why that isn't an accident, why I've purposefully not bought any or made any further investments in the past few months. And I also want to talk about what would cause me to start investing again. So those are going to be the topics of today's video. Of course, if you do enjoy it, make sure you leave a like. It helps me out a ton. And let me know your thoughts down in the comment section below. Let me know if you're buying stocks at the moment. And if so, what are you buying and how much are you buying and how conservative are you being with your investments at the current time? So I want to start by talking about my September purchase. So back in September was the last time that I bought anything or made an investment in anything. And even at that time, I didn't buy an individual business. So even though it's been such a long time since I've made an investment, the last investment I made was in an index fund. So that index fund is the VAS, Vanguard Australian Shares Index, that I have as a sort of a foundation of my portfolio. And the simple reason that I added to it was because at the time my cash position was built up to 60% and my equities was about 40%. And then I got my next month's income in and it was pushing my cash way too high compared to equities than I would have liked. And the other reason was that I like to keep that index fund at around 15 to 20% of my portfolio, and it was slipping below 15%. So I added some more to that position. And that's what I did in September of last year. So why haven't I made any purchases in the stock market since then? And the TLD, the short version of that is that I've found really great businesses, but they don't offer me a safe high return. So let's just talk about my strategy for a little bit so that you can understand if you don't understand what I mean by that. And what I mean is that there's two steps to investing. You have to find really great businesses and you need to buy them at a good price. And at the current time, I have a short list of really great businesses. And what a really great business means is that firstly, I understand it and its industry. I understand how it operates and what are the key factors that influence its performance in the future. Each of those businesses have an intrinsic layer of protection, an economic moat, some kind of competitive advantage that is allowing them to be better than their competition. And they also have highly competent and integral managements. Their managements have integrity, they're transparent, and they have skill at investing and managing their debts. So that's what classifies a great business. But then there's the second step, which is that we need to calculate what we can get back from these businesses and compare that to the price to ensure that we're making a high return on investment over the next 10 years. And at the current time, for all of the stocks that are in my shortlist, the ones that I fully understand and that have decided or analyzed as being really great businesses, none of them are offering me a 15% or more return safely. If I'm using conservative numbers, all of these businesses are offering me somewhere between 5 and 7% per year, which means that while yes, I could get a return that is above the risk-free rate, but I don't want to risk my money in a business that comes with a lot of uncertainty, because no matter how conservative you are or how good you are at analyzing businesses, there are many uncertainties that come with buying businesses, and those uncertainties could realize themselves. There could be things that go wrong that you couldn't foresee, or things that go wrong that you could foresee but you just didn't see them. And for that reason, you always want to make sure that if you're making an investment, that you're safely getting a really satisfactory return. And for me, that means that I want to safely get 15% or more. And then that's safely, that's conservatively. And then if they perform really well, or as I expect them to perform, I'm going to make a lot more, somewhere between 20 and 25% per year over the next 10 years. And that means that for the time being, I'm just going to be sitting on a larger than average pile of cash and wait for those opportunities. So, and the reason that I feel confident in waiting is that because historically, if stocks have yielded a low return, then there has been a drop in the stock prices in the near term. And by near term, I mean in the next few years. So if And so because stocks at the moment on average are yielding a low yield, you're getting a low amount of cash back for what you're paying because stock prices are high, then history says that over the next few years, we're likely going to see that change. And we're going to go through a period where there's a lot of fear in the markets and that prices are going to come down, and these stocks that are still really great businesses that are not affected by outside economic conditions over the long term will offer us a much better return. Now, I certainly don't want to be sitting in, 80 or 90% cash, but I am going to be sitting in a larger than average amount of cash because really we don't want to be 100% in equities or 100% in stocks ever, I don't think, because really if you're sitting 100% in stocks, then you're making a complete bet that the stock market's going to come down. And if you're 100% in stocks, then you're making a 100% bet that the stock market is going to go up over the next 10 years, or 5 or 10 years. And you should never be in either of those camps. You should always be making a bet each way, and the ratio of your cash to your equities depends on how you feel about the yield of the stocks that you're investing in. If the yield is very low, if they're not offering you a good return, then you would want to be more in cash so that when those yields come back down, you can buy them at a higher yield. And if the yield of those stocks is currently really high, then you want to be mostly in equities. You want to be deploying that cash into those businesses so that you can earn that high return. So because of course I'm earning an income, that means that my cash pile will continue to build up and up and up if I'm not buying stocks. So if it does get too high, I will start to deploy some of it, even though I can't get a really high return that I would like. Even though I can't get a return of 15+%, I will put a little bit of money into the market because I would rather have sort of 60% in cash and 40% in equities and have some of those equities earning me 5 to 7% rather than sitting in 80, 90 or 100% cash or close to 100% in cash and have most of or all of that cash only earning about 2% per year. Because at the end of the day, we can't predict if there's going to be a downturn or when it's going to happen. Those things are so unpredictable. So it is good to have a decent amount in equities at all times and also to have a decent amount of cash at all times, or at least that's my opinion. In terms of the past 7 months, of course, I have been earning income, so my cash has been going up. But if you've been watching my portfolio videos, my cash position really hasn't increased that much. And the reason for that is because I am deploying it. I'm just not deploying it in my stock portfolio, and I'm deploying it in my business because I'm getting a higher return on my investments in my business at the current time. And I think that's probably likely going to be the case for the foreseeable future, because especially if you find yourself that you've built a business that can generate you put $1 in and you get $5 out, then that is going to be a much better return than what I could get safely on a stock investment. So for the time being, that's what's going to be happening. I'm going to be receiving my income from my business, and I'm probably going to be putting a lot of it back into my business. So just to conclude quickly, what would make me start to buy stocks again? And essentially, I sort of explained it throughout the video. These stocks need to offer me a higher cash flow yield. Their prices need to come down so that of the cash that I've estimated they can produce over the next 10 years, the price is lower relative to that. I want to be paying a really low price so that I am confident that I'm going to get large amounts of cash back over the next 10 years. And that would be the reason why I start investing in the stock market again. So if you did enjoy the video, make sure you leave a like and let me know your thoughts down in the comment section below. Of course, if you're new around here, hit subscribe and join the team. But for now, guys, I'll see you in the next one.